Broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. This is Michael Blackburn. Welcome you to today's RetailStat Income Statement Analysis Education Program. For today's course, I will provide an accounting for non-accountants type review of the income statement. So for the next hour, we'll focus on the key knowledge to be attained from the statement without all the debits and credits and T account discussion that usually goes along with an accounting class. As always, if you have any questions, feel free to type them in and we can attempt to address throughout the call. And we'll also have some time to take any questions at the end of the presentation. Starting with the basics, what is a financial statement? We can say that accounting is the language of business. It identifies and records information and then communicates that accounting information through its financial statements. And companies prepare three key financial statements: the balance sheet, the income statement, and the cash flow statement. There's also the less important statement of stockholders' equity, which shows changes in that balance sheet account. So these financial statements consolidate and convert into useful information the accounting or transactions of the company. Each statement tells a different story about a company, and management relies on the financial statements to make intelligent business decisions and also to communicate with investors and other key stakeholders, both internal and external. So these stakeholders include creditors who rely on financial statements to evaluate whether a company or organization will be able to pay them back. So we, RetailStat, and most of you on the call would be included in this group. You also have your regulatory authorities like U.S. SEC. They rely on financial statements to determine whether a company meets the accounting standards required of a public company. And public companies are required to provide these financial statements quarterly. And then there are investors who rely on financial statements in order to understand whether investing in a company would provide a good return. Let me give a brief description of each statement before we get into the income statement in more detail. So the income statement itself includes all transactions, meaning the sales, expenses, and then the profits generated by a company through a period of time, say a quarter or a fiscal year. The balance sheet is an overview of the company's finances. It records the value of assets, the things that help generate sales, and the liabilities and equity at a period end date. So the liability and equity is what was used to finance the assets. So this is at a period end, say a quarter end or a fiscal year end. We always remember the equation that your assets, the left side of the balance sheet, have to equal your liabilities and equity on the right side of the balance sheet. The value of these balance sheet accounts are recorded at book value. That's a concept that we're going to use throughout today's call, meaning that's the cost value. Or if the market value drops below the cost value, then we write down the asset to reflect the market value. But if the market value increases, the book value just stays at the cost. So the only time we change that book value is when the market value falls below the book value. The cash flow statement is the third main one. It shows how cash is impacted by operations or the profit-making activities of the company, the income statement items, plus the investing activity, capital expenditures, and financing activity. Did they borrow money or issue equity during that period of time covered by the income statement? Simply put, the cash flow statement shows how a company receives and spends cash. Despite the fact these statements are prepared to make sense and simplify a multitude of various transactions, they are still difficult to understand, as the cartoon on the right depicts. We can also ask, where do we get the financial information or statements? So for public companies, these statements are filed with the SEC on a quarterly basis. For the first three quarters, the first, second, and third quarter, we have something called a 10Q. And then the fourth quarter is a 10K. It's the annual report. That fiscal year annual report is also audited by a third-party accounting firm, and it contains more data and disclosure than the 10Q reports. Public companies are also required to provide updates with the SEC for material events between the quarters, such as changes in key management, if they issued new debt or repaid new debt, any major transactions like mergers and acquisitions. So these are included in filings called 8Ks. So back to the quarterly reports, including in these is discussion from management on the results plus various notes disclosing additional details such as accounting policies or how they account for certain sales and expenses, details on debt, any pension liabilities, major litigation, things of that nature. Most significantly is the management discussion and analysis, where management discusses what drove the changes in the sales, margins, expenses, and profits, and so on. Before we get into these statements themselves, we need to introduce a concept called accrual accounting, which is different than a cash accounting. Instead of recording transactions on a cash basis or simply keeping track of cash inflows and outflows, or tracking revenues when they're received and expenses when they were paid, we have GAAP, or generally accepted accounting principles. We have the GAAP accrual accounting, which relies on something called the matching principle, where we match expenses incurred with the revenues earned, and this creates a mismatch between what we say is income and cash flow of the company. We'll come back and review accrual accounting in a moment. To help make sense of the financial statements, we employ various tools. We have comparative or horizontal analysis, or looking at performance trends over a period of time, say quarter to quarter or year to year, and or comparing performance to a peer, a competitor. When doing comparative analysis, it's important to do apples to apples, where we don't want to say compare fourth quarter results to third quarter results, because most retail companies, most companies in general, have seasonality that throws these numbers off. So you want to more or less compare similar periods. Fourth quarter this year, fourth quarter of last year. We also have something called common size analysis. So for income statements, we use margins, which is dividing expense or a profit into the sales to get a percentage. We use margins quite a bit, whether it's a gross margin, SG&A margin, or an EBITDA margin. Other tools include looking at data on a trailing 12-month basis, and that basically smooths out seasonality. So I talked about comparing quarter to quarter, but if you wanted to compare fourth quarter to third quarter, we would use trailing 12-month data. So for the third quarter, to get the trailing 12-month sales, we would take the first 3 quarters of this year plus the fourth quarter of last year. So we get a full year's worth of data. So in the fourth quarter, we would simply take the 4 quarters of that current fiscal year. So that's what we mean by TTM, or trailing 12-month basis. We also have various ratios to interpret data and compare sequential periods. There are many ratios, and together they help assess key measures of profitability, liquidity, which is the cash and cash flow, leverage, the amount of debt financing, coverage, like interest expense coverage ratio, efficiency, like inventory turnover, or even valuing the company. So once you get to know these tools, you'll find they're easy to calculate and interpret. However, we always like to warn, there really is no one-to ratio that tells us everything we need. So this all leads to the analyst asking questions of why. Why did sales grow? Why did debt increase? Why did this coverage ratio decline? Why did the expenses go up? So the income statement. It details how revenues are transformed into net income or loss, the profit, after taking into consideration all expenses. It reports on the operating performance over a period of time, typically a quarter or a year. So let's look at the structure of a typical income statement. It starts with what goods or services are sold that provided revenue. This is your sales, your revenues, or what we often hear called the top line. And then from that, we subtract the costs incurred to generate those revenues, possible other income items, and finally, what was the profit or loss, the bottom line result. Looking at the first cost, we have the cost of sales. This is a variable cost directly tied to your sales, how much you're selling. Primarily what is included in this number is inventory, if you're selling goods. There could be other items in this, but the biggest item is typically inventory. For example, some retailers would even include store rent in your cost of sales. So you take your sales, you subtract the cost of goods sold, and that gives you something called a gross profit. This is your profit to cover any overhead or primary operating expenses, any interest expense on borrowed money. The SG&A level what we often call is selling, general, and administrative expenses. These are generally your fixed operating costs, your overhead costs, your corporate costs, labor, marketing, insurance, accounting, legal, anything not directly tied to the sale of the good. This also includes something called depreciation and amortization. Depreciation is an expense for real assets. Amortization has to deal with intangible assets like a brand or a script or something like that. We use depreciation and amortization expense, these assets over their expected useful life. These assets are acquired at a certain time, but instead of the full amount of the cost for the asset being expensed immediately, we instead expense it over their expected useful life. For example, this is like our first example, the matching principle that I talked about. So we're matching this expense over time with the revenue generated from the asset itself. Say a retail store. If the company spent $10 million to acquire a store, that's the asset cost. So then they would capitalize that asset, put it on the balance sheet. They wouldn't expense the full $10 million on the income statement yet. They would have a $10 million CapEx, create the asset, and then depreciate that asset over time. Let's say it's a 10-year life. So we would depreciate the expense $1 million annually going forward for the next 10 years. So you can see right here how this matching concept and depreciation and amortization creates a cash flow timing issue. The cash is paid out now and then expensed over time as a non-cash depreciation expense. So that, again, the cash isn't going to necessarily equal the income of the company. Other issues that might be in this operating are one-time items, extraordinary items, say a non-recurring. They only happen one time and they're not something that happened last year and they're probably not going to happen next year. It could be a restructuring cost. Maybe they had an impairment of an asset. They wrote down the value of that asset. Maybe they sold an asset and they generated a gain or a loss on that asset. So after we back out all those expenses, we get what's called your operating income. All right, so that's income from selling the goods and services of the company. Anything below this, including interest on debt and taxes, is non-operating related. So from operating income, we consider other income or expenses not directly tied to running the business. This could be income or dividends from minority investments, a sale from a non-core asset, or anything like that. Usually it's relatively minor. We back that out, and then we get what's called earnings before interest and taxes. From there, we can pay our interest expense, and that's from cost of financing or debt that's outstanding, any interest related to that. Typically, it's an expense. However, if you're generating more interest income than interest expense, it's going to be we'll have a net interest income in this line item. That's from investments that the company might have, and we'll assume that they don't have much outstanding debt to offset the interest expense. So we back that out and we get our pre-tax income. From that, we calculate our taxes. Back that out, we get our bottom line net income. And the net income itself is used to pay out any dividends. Anything left over after dividends flows back into the balance sheet as retained earnings in the stockholders' equity column. So you can see how these financial statements are related. So the income statement, just to kind of summarize again, is a report card for a quarter or year of how well a company generated sales, how they managed their expenses, and what's resulted in a profit or loss. It leads to questions, right? So you want to start asking questions. What drove the sales change? Why did it go up or down? Are costs rising faster or slower than sales? Was the expense leverage or deleverage? What drove the change in margins? Is interest expense rising or falling? Is income over the bottom line keeping pace with sales? Were there any extraordinary or one-time charges or gains, and why? What did they mean? Discontinued operations. Did the company divest a big part of their business and result in a discontinued operation? So we're going to review all this on a trend and peer basis and help explain, all these items that we're going to be going through. So let's get back to, this concept called accrual accounting. Again, this is more complicated, but also more useful than cash accounting. Cash accounting captures only cash receipts and cash payments. This cash flow accounting revenue is any money received, and an expense would be any money paid out. It's basically how most of us account for our own personal finances. And in this situation, your net income equals your cash flow. Your net income, again, meaning your inflows of cash minus your outflows. With GAAP accrual accounting, we're relying on this matching concept. First, with revenue, we realize or record the revenue when the goods and services are delivered or earned, not necessarily when the cash payment is received. If revenue is recognized before the cash receipts, an asset, an accounts receivable, is created on the balance sheet. So on the balance sheet, you debit that account, that asset, accounts receivable for the difference between the revenue recorded and the amount of cash receipts received. This happens when a product is sold on terms, say net 30. Think about double entry book balance sheet impact. The full sale of the net income from the sale, so you record the full sale on the income statement, it hits your net income, that flows back onto the balance sheet into the stockholders' equity account. But only a portion of the sale was actually received in cash, right? So we got to account for that difference where the cash isn't impacting the asset side. So you need to increase the asset accounts receivable to keep the balance sheet balanced. Another way of looking at this is if cash from a transaction is received before revenue is recognized, typically like with a subscription service, the cash goes up. We receive that cash from the sale of the subscription, but we don't record the sale until it's earned. So it's not included in the stockholders' equity. It's not hitting the right-hand side of the balance sheet. So what we have to do is increase that right-hand side with a liability, something called unearned revenue. It's credited and the liability increases. The liability is debited and decreased in the subsequent periods in which the revenue is recognized and effectively included in the stockholders' equity. This, again, can occur with a prepaid subscription. Again, here you owe something to you earn the sale, so it's a liability. So that's why we record it as a liability. The same principle goes with expenses, matching the expense with the revenue when they are incurred or used up, and then expensed during that relevant period. If the expense was something that was acquired, like inventory, and not yet used up or sold, they are assets on the balance sheet at the end of the period. So the inventory was not yet sold is an asset. These assets will become expenses recorded on the income statement in future periods as they're used up, as they're sold. You match the expense with when the related sale is realized. So when that sale of the inventory is actually realized, you expense the inventory cost and cost of goods sold, and it creates, again, this matching concept. Some expenses are incurred or expensed and recorded on the income statement, which reduces stockholders' equity and then results in liabilities because they have not yet been paid, but will be paid or paid in the future periods. So this is an accrued expense. You hear that term a lot. A simple example would be accrued salaries, where you incur the salary expense for the period, but did not pay for it. For example, if you pay salaries every 2 weeks and the quarter is in the middle of the pay period, you would accrue or expense 1 week's salary expense and credit accrued liabilities for the same amount. So you haven't actually paid it. So you can see one of the problems with accrual accounting is the mismatch between bottom line net income and cash flow. With accrual accounting, we can have large differences between net income and cash flow. Despite this, GAAP prefers accrual accounting to better understand how a company actually performed during a particular period. And it also creates a need for the third key financial statement, the cash flow statement, which reconciles this difference between net income and cash flow. We covered depreciation and amortization expense and how this expense is created with something called CapEx, which creates one of the biggest mismatches of expensing and cash flow. Capital expenditures, again, are not immediately expensed, but create a fixed asset on the balance sheet, which is then expensed over the useful life of the asset. This future expense, again, is called the depreciation expense. And again, it creates that mismatch between net income and cash flow, and unraveling that all has to do with the cash flow statement. So let me just use a simple example of accrual accounting. During 2020, RetailStat sold and billed customers $50,000. All right, so we generated sales of $50,000. On December 31st, 2020, it received $40,000, with the remaining $10,000 to be received in 2021. So that's your sales and revenue part of the equation. Looking at the expense, the company acquired inventory for $40,000, of which $30,000 of this inventory was sold to generate the $40,000 in sales. They also incurred $5,000 of overhead costs, resulting in total incurred costs of $35,000, with $5,000 of these costs not yet paid on December 31st. So how did they get the $35,000? Well, the $5,000 in overhead and the $30,000 of inventory costs. So there's your expense. Determine net income on the cash and accrual methods. Well, the cash, again, is just looking at receipts and disbursements. All right. It received $40,000 and it paid out $40,000 worth of, it purchased $40,000 worth of inventory, incurred $5,000 worth of overhead, but $5,000 wasn't paid. So you had total disbursements of $40,000 and income cash flow is zero. Your actual cash flow will always be the same whether you're looking at a cash basis or accrual accounting. The difference, again, will be the net income. So how do we calculate income and a balance sheet impact using accrual accounting? Well, we recorded total sales of $50,000. We earned $50,000 of revenue during that year. We had expenses related to that revenue of $30,000. That was the cost of the inventory sold. So that gives us a gross profit of $20,000. We also incurred overhead of $5,000. So we back that out, we get income of $15,000. So right off the bat, this $15,000 flows onto the balance sheet as equity. Okay, so what about the other items that happened? Well, $10,000 of our revenues was sold on terms, and we haven't collected yet, so we have an accounts receivable asset of $10,000. We also acquired $40,000 of inventory, but only sold $30,000, so we expensed $30,000 and reduced inventory by $30,000, which left us with $10,000 of inventory. We know our cash flow impact was zero, so we have $20,000 of assets, and that equals our liabilities and equity of $20,000. Just a real quick, simple example there of how to calculate, a balance sheet and income statement using accrual accounting. So now we have a simple understanding of the income statement. Let's look at an example. So in the next two slides, we're going to look at Rite Aid's fiscal year income statement and their first quarter income statement. I mean, Rite Aid is a high-risk account that we've had a lot of updates now, and certainly we're not going to really get into the issues necessarily with Rite Aid, but they are certainly a high credit risk. And if anyone has any questions, in terms of that, and are not aware of what exactly is going on with Rite Aid, I would encourage you to call me after this call. So if we look at the income statement, we can kind of track it. Let's just look at the structure first. One of the first things that pops out, they start with revenues and they go with cost of revenues, your cost of goods sold, and your SG&A expenses. And then they have a bunch of one-time items. But the interesting thing is they don't really break out operating income. They lump interest expense in there, and they've got a bunch of gains and losses on assets and debt changes as well that are included in there. So they have kind of unique, they kind of go right to your earnings before taxes, and then you have your income taxes, then your net income. Then below that, they've got some calculations for your earnings per share, which is just taking your net income, dividing by your total shares outstanding, the common stock shares that are outstanding. We'll come back to this concept of earnings per share in a second. But just kind of looking at the numbers, you can kind of eyeball, well, sales went up and then they went back down. So they've been kind of flattish the last couple of years. Even, then you notice this is a 53-week year compared to 52 weeks in the prior year, and sales still decline. So that's obviously a red flag. They're not doing much to generate new revenue. Cost of revenues really didn't change much. SG&A came way down. So that's a pretty good, sign that it went up and then it came down slightly in the current year. So that's a pretty good sign, even with the extra week, that they were able to cut some costs there. But it also tells you a story, though, why are they cutting costs? Well, you look at their revenues and they're not really growing, so they're trying to find ways of preserving their profitability. Then you look at these one-time items. There's an exit and impairment charge. That's a red flag. They must be divesting assets and reducing the value of their assets. They also wrote off some of their goodwill, which is the value of their prior acquisitions of assets and intangible assets. So that's a negative. That means these assets now, the market values drop below the book value, so they had to write off the value. You look at interest expense, and that's increasing. You could say, is that higher interest rates, or are they borrowing more money? They did modify some debt, so it looks like they repaid or restructured their debt. Usually that results in a loss, a modest loss, because the book value of debt can be slightly below the fair market value of debt because of certain discounting and where they record debt itself. But in this case, it was a large gain. So that would indicate that it was probably a distressed debt exchange, meaning they repaid the debt at a haircut below the par value of the debt itself. So that could be a red flag, obviously. And the fact that they're selling assets, it's not unusual that you generate a gain there because you depreciate the asset over time. So usually the market value is more. So we'd like to see, well, how much money did they actually generate from the sale of those assets? But bottom line, you're seeing the losses of $756 million and then a slight tax benefit. So they lost about $750 million, which is up from the prior years. Part of that are these one-time items, but this company is not performing well. You can tell right off the bat, but it's still kind of difficult to understand what exactly is going on. And then tracking the first quarter numbers, you see sales are down. Your cost of revenues also went down about the same dollar amount, so that maybe they held on to their margins a little bit. And SG&A costs were still kind of flattish, but they still had some more of these one-time charges, so they're still closing stores likely. They took another good impairment charge here, and they're still losing bottom line earnings. So obviously a lot of red flags, but look, we could make more sense of these numbers, and let's start introducing some of the key data points, ratios, and things we look at when we analyze an income statement. So starting off, we have sales, the top line, right? And obviously declining sales, as we're seeing with Rite Aid, that's clearly a big red flag, because without strong sales, everything else becomes much more difficult. Could lead to one of the things that happen with lower sales is you could be divesting businesses, selling assets. If they're underperforming assets, that might be a good thing, and maybe the rest of the business is in much stronger operating performance. But as we saw with Rite Aid, they're divesting some of these assets, but they're still losing money, so that's not the case. So usually declining sales is not great. Higher sales is also not always a positive. You could have a company that's growing very rapidly in terms of they're expanding their store base, say 10% a year, but their sales are actually only growing by about 1%. So that's a mismatch. You want to see that sales growth kind of catch up or even outpace the actual store expansion rate. The nice thing with retail companies is we have a unique piece of data called comparable store sales or same store sales. Short for comparable store sales, we call it comps. They're a better indicator of sales because they provide a comparative sales analysis that only includes stores that were open during both periods. And so it provides a truer apples-to-apples sales comparison. So it's not going to include any stores that were open or closed during the comparison periods. They eliminate those locations. So you can see what their true organic performance has been on a sales basis. You could also look at sales per square foot, which is just taking your total sales and divided by your gross or your net square footage for that location. That gives you an idea how they compare against competitors. But it's also obviously important to take into consideration, the different markets a company might be in, whether it's a rural or an urban market. And then we have their gross profit and your gross profit margin or your gross margin. It measures the retailer's markup ability over the cost of the asset itself. So it's your sales minus your cost of goods sold, which again is your gross profit, divided by your sales. So this is a profit margin. The higher, the better. On the expense side, you take the overhead, the operating costs, the SG&A costs, and divide it by sales. You get your SG&A margin, a measure of how well a company leverages its operating expenses, not directly tied to producing the goods or services sold. over its sales base. The higher the SG&A margin, the less efficient the company is perceived. We typically back out depreciation and amortization from this ratio as well. So this, again, it's an expense margin where you have the expense as a numerator, sales as a denominator. So as your sales increase, this leverage ratio, this margin ratio will increase as well, and that's a negative. Or conversely, your sales may be decreasing. Worst case, you have higher expenses and lower sales, which really creates this number to balloon over time. So that's your SG&A margin. Again, we like to look at things on a trailing 12-month basis for sales, expenses, and profits. That helps deal with smoothing out the seasonality impact and comparing successive quarters. In terms of looking at profit numbers, you have operating income, you have net income. We feel EBITDA is the best measure. And EBITDA is defined as earnings before interest, taxes, depreciation, and amortization, or simply that operating income plus depreciation and amortization. This is the best comparison for year over year, peer comparison. It eliminates what we do when we calculate this number too, is we back out non-cash, non-recurring items, those one-time items. It compares apples to apples comparison. And when we look at things on a margin basis, we can compare it with our peers as well, right? So we take EBITDA divided by sales, we get an EBITDA margin. And obviously the EBITDA is the profit, so we want a higher margin as possible. What is a good margin? It really depends on the retailer, the sector, their business mix. Traditionally, if you break it out by sector, say, like a department store sector they sell mostly apparel and things like that, slow-moving goods. They don't really have a heavy turnover. And the cost of those stores are pretty expensive. They invest a lot of money into their stores. So they expect a high profit margin. And a good department store should have a double-digit, 10% or higher EBITDA margin. Conversely, you could take like a wholesaler, like a drug wholesaler, like a McKesson or Cardinal or Amerisource Bergen, and that margin might only be 2% or so. They don't invest a lot in their business, and they have a very rapid turnover. They might be turning over their inventory 10, 15, 20 times a year compared to that 3 times, 4 times of a department store. So they can get by on a much lower margin. So again, it's kind of industry and sector specific when you're talking about what is a good margin. To kind of show how you could use an empirical analysis, you could take a look at 2 companies, and if you're just looking at their income statement and just you calculate their EBITDA. Oh, and by the way, EBITDA is not a number you're going to see on the income statement, right? I didn't show that when we showed the structure of the income statement. It's not a GAAP number. Companies don't need to report EBITDA, but it is something that's pretty easy to calculate, as I defined just before, and we'll come back to it a little bit more in subsequent periods. But if you calculate the EBITDA and you determine, well, both these companies have $10 million of EBITDA, but then you look at the margin. One company has $100 million in sales, so they've got a 10% EBITDA margin, and the other company has $1 billion in sales, so they've only got a 1% margin. So the smaller company, even though they generate much less revenue, they're doing the same thing, say, as the larger company. So they could be a real threat in future periods if they keep growing their revenues at the current rate that they're doing business with. So that gives you how the ability of using margins to kind of do a peer analysis. The next couple, so these are performance ratios. The next are coverage or leverage ratios. And these are probably 2 of the most important ratios for any credit analyst. The first is the interest coverage ratio, and just looking at the formula, you take your profit and divide it by the interest expense, or the amount of interest you've got to make on the borrowed money. So these are contractual terms debt, right? You've got to make that interest payment, and at some point you've got to repurchase that debt. So the higher the ratio, the better, because you're looking at a EBITDA as the numerator. When the ratio is at like 1 times, it basically means that if we look at EBITDA as kind of the cash flow ability of a company, they're just generating enough profit to pay their interest. So that should be a warning sign. And nice thing about the interest coverage and debt to EBITDA ratio is it doesn't matter what industry or sector you're looking at. A good coverage and good debt to EBITDA ratio are pretty much universal. Anytime you see interest coverage fall below 3 to 4 times, that's a warning sign. Anytime you see the debt to EBITDA, now we're looking at debt divided by EBITDA. We have debt as a numerator, so you want as low a number as possible. But anytime you see that number drop, rise higher than 3 to 4 times, that's a warning sign. So it's that 3 to 4 times amount that's really key for both of these ratios. And again, no matter what company you're looking at, they tell you, give you a good idea of what's going on with this company, is whether it's risky or not. So what is this showing us? It's showing us the profitability of the company and the financial risk of the company. How profitable and how much risk have they taken on to finance their operations. So a bad number here could mean low EBITDA or high interest expense, or a combination of both. A bad debt to EBITDA could mean high debt or low EBITDA, or a combination of both. So it leads to other questions again, going back to how we use these ratios to ask questions and how we can kind of peel the onion and find all the layers of what's going on with a particular company, and why these two ratios are really critical for any credit analyst to understand. And again, smooth out the seasonality, use TTM EBITDA and interest expense, debt at whatever the latest fiscal year end period that we're looking at. So to kind of summarize, we've got EBITDA as our key performance ratio, EBITDA divided by sales. We could also just look at operating income divided by sales as well, but it's better to strip out that non-cash depreciation and amortization, especially when we start looking at our leverage and interest coverage ratios. We could also look at net profit margins, your net income divided by sales, but I'll come back to why we tend to move away from these and tend again to focus on EBITDA or even operating income over the bottom line income. And then we have our leverage or coverage ratios. We could look at operating income divided by interest expense, or EBITDA divided by interest expense. We think that's a better interest coverage ratio to review. So we had the income statement, which showed us something was still tough to interpret. The next step then is to spread the numbers, calculate the margins, calculate the ratios, and then show the percentage changes, and also keep track of the trailing 12-month data of the company. So here's our financial snapshot that we include in all reports for the operating performance categories of the company. And this is for Rite Aid. This is their first quarter ended June 3rd, 2023, compared to the prior year first quarter of May 28th, 2022. So right off the bat, we're kind of looking at this, and it's leading us to a lot of questions. We look at sales. Sales dropped 6% in the quarter. We say, well, why did sales drop? Well, they closed some stores. That was down 3%, but that didn't account for everything. And then interestingly, their comparable store sales increased 8%. So that's odd. The retail store sales increased 8%, but they only closed 3% of their store base. So how did sales drop 6%? You can look at their margins. They actually had a slight improvement in their gross margin, but that was offset by their SG&A margin. We saw that their actual SG&A costs were relatively flat. So which they called deleveraged, even though they had flat overhead costs, because of the lost sales, they deleveraged this margin, right? The expense was flat, but the sales number dropped, so the ratio went up. We then calculated the EBITDA, and that dropped about 8% to $92 million. We look at the margin, it's only 1.6%. So right off the bat, we could say, well, that looks pretty low, right? I mean, that's like a wholesaler's margin. And then you're looking at the TTM number, that was only 1.8%. So they've been in a declining margin trend lately. Operating income was down 14%. Then you see their interest expense was up almost $20 million during the period, or 35%. And then the bottom line loss of $307 million. Then we calculated their interest coverage ratio. We could see for the quarter was 1.4, and TTM was only 1.7 times. So it's well below that 3 to 4 times number that we like to look. So this is an issue. We're guessing because of the higher interest expense that they have a lot of debt, and we can see already that they don't have a lot of profitability. We also have their capital expenditures, which has actually fallen, which means looks like they're conserving capital there by reducing the amount of expenditures back into the company itself. So we have this snapshot, and it tells us a lot, but it doesn't tell us everything. It really doesn't tell us why this sales changed. Why did interest coverage so low? Also doesn't explain, what is this business? What does Rite Aid actually do? Are they a drug retailer? What other activities created sales and expenses? And then if we dig a little deeper now, we could find that, well, Rite Aid is a pharmacy business, but they're also what's called a pharmacy benefit management business. They have a company called Elixir. So in the pharmacy business itself as well, we have basically two types of business. We have the front end of the store, which is selling their over-the-counter medicines and supplements and other products. And then in the back of the store, you have their pharmacy, the prescriptions part of the business. Their prescription part of the front of the retail side is about 70% of the retail side of the business. And retail itself is over 70% of their total revenues. The rest, the remaining 30% of the business was the Elixir. And Elixir had been about 30%, but their sales have basically been falling off the map. Last year, their sales were down around 21%. In the first quarter, they fell another 31%. So you could see that just looking at these numbers, we do some investigations, we read the reports, we dig out, well, what is this company doing? What is their business mix? And we can see that 70, 80% of their business is retail, drugstores. Another 20, 30% is this PBM Elixir. And then we kind of investigate how are each of these businesses performing. And we dig a little deeper on the retail side. We see the comps are up 8.4, but we footnoted down here, that included a 4.4% decrease in the front end part of the business and a 13% increase in pharmacy. So pharmacy is really what's driving that comps. And the interesting thing about this mix of business now is front end is the highest margin part of the business for Rite Aid. So that's been declining. And then the pharmacy business is relatively low end, and there's been more pressure on this business in terms of the reimbursement rates for the pharmacy side of the business, and that's been declining. So that's could indicate, well, that's an interesting trend. Then you see the gross margin actually increase. So what happened there? If front end is lower margin, front end is higher margin but was dropping, and pharmacy is lower margin but it's been increasing, and we know that the PBM business's sales is decreasing. Well, actually, the PBM profitability has been improving a little bit because they've been divesting some or losing some of their less profitable PBM business, their Medicare Part D business, which is very low profitability. So they've been shedding some of that business. And that's what really drove the gross margin improvement and kind of offset some of the overall erosion and overperformance in the retail side of the business. So again, so we're getting a better picture now. This, again, we have the ratios, we have the margins, and it kind of leads to all these other further questions down the road. So getting back to the income statement and the net income number and earnings per share, just quickly, we define earnings per share basically as that bottom line net income divided by the total number of common shares outstanding. And that, say, take an example, would be a company that generated $2 million in net income, 3.6 million in shares outstanding. They generated about 55 cents per share. You see that quoted a lot. And that could tell you something. If Rite Aid's generating 55 cents a share, but CVS and Walgreens generating $3 or $4 per share, maybe that they're not doing as well. The problem we have with net income, it's a very noisy number. And then you're paying your taxes, you're paying your interest. It's not really reflective of the operating performance of the business. It can have all these one-time items in there as well. The other thing with earnings per share is the shares outstanding, the company could be repurchasing shares. So even if their earnings were flat, your earnings per share is going to increase if you're reducing the number of shares outstanding. So you knock that down to 3 million shares next year, and now you're generating about 67 cents per share, even though your profitability didn't improve. So we tend to shy away from these numbers and, again, focus on EBITDA. But, again, earnings per share is your net income divided by your shares outstanding. We could also look at your return on your assets, your net income divided by your total assets, the amount you invested in the business. But you can see, again, with looking at assets, if you're dealing with an older company, a lot of their asset values may have been depreciated over time. So that could overstate your return on asset value. Or if you're a new company, your asset values kind of reflect your market value, and that could understate your return on assets. So again, it gets kind of noisy. And then return on equity, your net income divided by your stockholders' equity, the book value of your equity, not the current market value of your equity, meaning the share price that's quoted in the Wall Street Journal and things. So again, this is a noisy number too, because it's historical. It can be reduced because of share repurchases. It could be increased because of share issues. So it's a very noisy number, and we don't really spend a lot of time discussing these types of investment returns. The other thing earnings per share or share prices and earnings per share and net income can be used is for valuation ratios. You often hear with stockholders, they talk about a price earnings ratio or PE ratio. And it's basically your market capitalization or the total value, the market value of your equity divided by your net income. Or if you just look at the share price for one share divided by your earnings per that one share, you also get a PE ratio. And, you could do this for a company in terms of valuing, is the ratio high, low, and where is it compared to their competitors? You also have to consider, like, is this a growth company or not a growth company in terms of what is a proper PE ratio. I did, just as a learning exercise, it included the Shiller PE ratio for the S&P 500. Bob Shiller is a Yale professor and economist. He also tracks the housing market with the Shiller Home Index. But he does this PE ratio, which is you're looking at the earnings per share of the S&P 500 companies and the total capitalization, the total share prices of all those S&P 500 companies. So the S&P 500 share price divided by all the earnings of those S&P 500 companies. And kind of tracks, well, where is the market? Is it overvalued, undervalued? And you can see he's got quite a bit of amount of data, goes all the way back to the 1870s in terms of tracking PE ratios. And you can kind of track it over time. And you can see back, the Great Depression, it was at a peak and then came crashing down. The dot-com era, it was even higher. It approached 45 times at that time and then came crashing down. Historically, that number has been in the mid to high teens in terms of the average. And even if you strip out, these earlier periods, which maybe they're not comparable to current periods, a lot of things have changed with finance, obviously, over the last 100 years or so. But even if you look at the last few years, you can see the PEO about 31 times. It's still relatively high compared to where it had been, going back to, say, the 70s and 80s. If you kind of strip out some of these peaks, we're a little bit high compared to where we are. I'm not trying to provide investment advice, just as a kind of a learning tool, what this all means. So what are the benefits and what are some of the downsides of using these ratios? The benefits are obviously the ease of calculation and interpretation and how we can use them to compare things and use trends and peer analysis and things like that. And we can decompose these data points to reveal the sources of the changes again. Remember what drove this change in sales and earnings and things of that nature. The downside, pretty obvious. It's monetary, very simplified expression of what's going on with the company. It doesn't take into consideration the type of business the company's in, the market share, competitive encroachment, shifting consumer trends, and these other softer issues. It's obviously backward looking. We're looking at historical values. There's certain issues with sensitive accounting methods in terms of how do you account for revenues and whether you're exaggerating sales or underestimating costs. A good example here, most people on the call can understand, would be like for bad debt expense. Companies have to estimate the liability associated with their sales in terms of returns or not being paid. They underestimate that bad debt expense. That could be overstating their profitability if they're too aggressive in that sense. Most of the time when you exaggerate or underestimate, you get into trouble with your accountants, and particularly your audits. They'll say, you're under accrued here in terms of your bad debt costs. In terms of the asset values, you're looking at historical cost and book value balance. Doesn't reflect the market value unless that market value dropped below the book value, and then we write off the value of that asset to reflect the current market value. And again, no one ratio of financial measure tells the whole story. The nature of financial analysis to gather and dissect all the information and to make a decision. So it brings back that analyst as being really key in terms of making those credit decisions. Even when you're looking just like a credit rating, we have our own internal credit rating, and it's very useful. But you still have to be able to have the analyst go in and interpret, what does a D credit rating mean? Are they really in bad shape? Or maybe they have years to operate. What does an E or an F credit rating mean? So they're a starting point to kind of unravel that onion again. So if we take bringing it back to Rite Aid and then bringing back the sales analysis and trend analysis over time, we could look at Rite Aid and see, track their sales over the last few years, and you can see, wow, really fell off the cliff here. Then they had some growth, and now things are trending down again. This is their trailing 12-month sales data for these respective first quarter periods. And then you kind of say, well, what's going on here? Well, you look at comps. Well, comps have been mostly positive. And then you look at store count. That fell off the map back in 2017 and 2018, and it's been slowly declining since then. So you can kind of say, well, maybe some of this growth is comparable store sales, the retail side of the business. But then again, you've also got to realize Elixir, the PBM, is not included in your comps. So that reflects that. And you can see the big drop here was they sold about 1,900 of their stores, mainly in the Southeast, to Walgreens back in 2016 through 2018. So they slowly transitioned those stores over to Walgreens during those periods, and that resulted in their total sales decline. So you take into consideration store openings, closings, acquisitions, divestments, different businesses that they got in to try to understand what's going on with that sales trend. And then we have the gross margin analysis. Again, this is more of a variable cost. It's directly related to producing the goods or services sold. It's primarily that inventory cost, which is tied to the sale that we generated. You expense the inventory with the gross margin. So what changes, what drives a gross margin? The cost of the inventory itself. Is it increasing in cost, decreasing in cost? The markup above that cost, any subsequent promotions or markdowns, the obvious stuff, right? You can also, though, have improved inventory management. Maybe you're lowering your overall contributing costs to your cost of goods sold. Is there any shrink? Shrink's a big issue right now. We're seeing it called out throughout retail. It's in the headlines everywhere. It's mainly has to do with a lot of organized theft right now, and it's having a big impact on a lot of retailers, including the drug retailers. Walgreens called it out. Last year they were saying, typically we do like 1% shrink, and that had gone to about 3% shrink. So that's a significant amount of shrink when you're dealing with a company whose retail business is like $100 billion a year. It's a huge amount of cost to them. And when you're only generating relatively minor single-digit profit margins, it really adds up. Scale in terms, not just in terms of getting better pricing, but also the overall scale of the industry, of the company, and the way they're able to leverage their costs, given their larger size. And obviously that's been a winning measure for a lot of retailers in recent years. The big have just gotten bigger. They've built scale, and that's allowed them to have a competitive advantage. Price inflation has an impact. Typically, retailers like to see a little bit of inflation, right? It helps their profit margins. Say grocery, for example, thinks their inflation sweet spot is 3 to 4%, meaning they absorb their higher costs by passing through their increased costs through a sales increase. So they're able to pass on that higher inflationary cost to their consumer. If you take an example here, say a company had a cost increase of $10 or 10%. They pass, or let's just call it $10. And let's say they pass 100% of that through the sale. So if they sold the product, say for $100, the cost of the product was $60, they had a 40% profit margin. Next year, the cost goes up 10% to $110. They now sell the product for $50 for a $50 profit. Because they captured 100%, their profit margin went up 45%. They actually increased their gross profitability as well. So you can see how some price inflation is helpful. You have the reverse impact on deflationary pricing. That's not good. It reduces your marginal profitability typically. The other thing that impacts gross margin, competitive price pressures in terms of we've seen the return of promotions starting last year, going into this year, particularly on discretionary goods. People are being more promotional to sell product, to keep their store traffic up. And then the product mix. We talked about Rite Aid with the front end versus the back end business, and how the front end has a stronger margin than the back end. And then if you take the gross margin, you calculate it for the companies, and you can kind of compare it. Although, again, you got to be careful because you got to consider the product mix. And each of these companies now have kind of a unique product mix. Rite Aid has the pharmacy business, which is now 70 going to 80% of their total business, plus the elixir business. Walgreens has been divesting, or they really divested a lot of their European health wholesale business, and now they're primarily a U.S. retailer. About 80% of their revenues are driven from their U.S. business. However, they still have an international pharmacy business as well as they're growing their primary care business. So they're opening a lot of clinics. They're hiring physicians and nurse practitioners and physician assistants to staff these clinics. So they're very interested in getting into the primary care business. CVS as well. They're moving into this primary care business. So this has been disruptive for both Walgreens and CVS in terms of they're trying to grow this business, which is very expensive, and it's not really profitable for them right now. So that's having a negative impact on their overall profitability. CVS also has a pharmacy benefit management business, but also has an insurance business, a healthcare insurance business. They own Aetna. So you can see each of these retail pharmacies are quite unique, and their margins are all quite distinct. But the one trend you can see is that each one of them is declining. And you might say, well, Rite Aid actually had the strongest gross margin. Maybe they're the most profitable company, but we know that's not true because we saw their EBITDA performance. The next thing we're going to look at is the cost margin, SG&A margin. And again, these are the overhead. They're more fixed, sticky costs. They tend to not change that much from quarter to quarter, or even necessarily year to year, unless there's large restructuring and cost cuts where you're eliminating labor, you're slashing your marketing and things like that. They tend to be more static. So this is a measure of operating efficiency of the company. Increase in the ratio indicates inefficiency and inability to control costs. A decrease indicates efficiency and ability to control costs. Again, we want this margin number low as possible. Improvements, usually it relates to sales, whether you're growing sales or decreasing sales, because again, they're fixed. You can leverage those overhead costs and decrease the margin by increasing the sales, which are the denominator in the equation. And then, if you're increasing or decreasing, maybe you're ramping up or slashing advertising. Maybe you've got a new labor contract that increased costs. Healthcare and insurance costs are obviously an issue. Rent, fuel costs, and things like that. Expansion will obviously increase this number. Even though it's fixed, as you grow, you need to hire more corporate overhead costs to increase that. And it takes a while for the sales to catch up with that. So initially, there'll be some deleverage and it'll decline over time. And we are seeing, Rite Aid was flat. Walgreens had declined somewhat, and CVS has declined as well. And you kind of see the reverse in terms of the gross profitability here, in terms of the expense margin, where CVS had the lowest, but they had the healthiest SG&A margin. So that leads us to the EBITDA. And again, just to kind of recap the EBITDA calculation, again, this is a non-GAAP number. It presents a truer picture of operating profit by eliminating the non-cash depreciation and amortization, non-operating items like taxes and interest expense, and those non-recurring items. The one fault, it does not consider the capital expenditures, the amount you're reinvesting into the business. And here's some guidance for Rite Aid in terms of their EBITDA and how they projected it. They kind of went the long way, starting with the net loss that they're projecting and then adding the income tax and interest expense and all the other one-time items that are included in there. And so this is a big drop in their EBITDA guidance for the year. Last year, they did $430 million in EBITDA. So that's obviously points to the risk with this account. Even by their own accounts, they're seeing a significant drop off in their EBITDA. So again, anybody has any questions on them, feel free to reach out after the call. So CVS, and then looking, boiling it down all to the EBITDA margin, you can see, compare the numbers, and you can see Rite Aid, even with the different mixes, clearly at a competitive disadvantage. Walgreens itself is having a lot of trouble. Their margin is way down. COVID has been a headwind, as COVID was a huge margin boost and profit boost for all the retailers. So that's having an impact across the board. The other thing that we're seeing across the board is reduced pharmacy reimbursement rates. So pharmacies are making less on the prescriptions they sell. The other big thing is labor costs are up. Hourly wage rates are up. They're spending more to support their staff. So that's having a negative impact on the overall marginal profitability as well. So then finally, the coverage ratio, and then just kind of we're looking at Rite Aid again. We talked about how that came way down in the last few years, 1.7. But even going back a few years ago, they were still a high risk, below 3 times. And then compared to their competitors, Walgreens and CVS, it's deteriorated a little bit. I talked about their move into primary care. They're doing a lot of acquisitions, so they're spending a lot of cash. Even though Walgreens and CVS generate good cash flow, they are spending a lot on acquisitions to expand into that primary care business. So with that increased debt and the reduced earnings, EBITDA, these numbers have increased a bit, or decreased a bit, but still pretty healthy. And then obviously Rite Aid here with their 1.7, well below our warning sign of 3 to 4 times. So finally, I just thought I'd throw in this last slide, just kind of show the relationship with the income statement, with the balance sheet and the statement of cash flow. And I've already kind of talked about some of these points. The income statement provides a measure of profit over a period of time, but does not equate to the cash that the firm generated in GAAP accounting. Revenue reported but not received creates an asset. That's at accounts receivable. Expenses reported but not paid creates liabilities. That's at accounts payable or accrual. So just kind of jumping to the cash flow, you can say, you know, when we create these assets, that's a cash use, right? You didn't collect that accounts receivable, so it's a cash drain on a company. When you collect on the receivable, that's a cash flow positive. So lower assets equals cash positive. Expenses have that inverse relationship. When you have accounts payable or accrual, you haven't paid it out yet, that's a cash positive. And when you pay it off, that's a cash negative. So lower liabilities is a drain. There are also expenses that are reported that were paid in the past, the depreciation and amortization, which is an expense, which we add back because we already paid, the cash already went out the door for that. Any net income after dividends is included in stockholders' equity as retained earnings, okay? So this income statement is tied to the balance sheet through these asset and liability accounts, but also with the bottom line earnings, which flows into the stockholders' equity. And then that bottom line net income, which flows into retained earnings, is a starting point for the statement of cash flow, which is then adjusted for the changes in the asset and liability accounts and the non-cash depreciation and amortization expense, thereby unwinding or reversing the GAAP accrual accounting to calculate operating cash flow. From the operating cash flow, we have their finance or investing cash flow, which is primarily your capital expenditures. And then you have your financing cash flow, which is your stocks and bonds, issues, any dividends and share repurchases and things like that. So that's the end of my prepared remarks. I do have some time, you know, if anybody has any questions, we could sit here and address. Just see. What free tools are available that help you compare the performance of retailers? You know, there are some, you know, there's a site called Free Edgar, where the SEC has all their filings. So that's your first resource. You know, you see the 10Qs, the 10Ks, the 8Ks. So all the financial statements are right there for you to calculate and figure out yourself. All right, I don't see any other questions, so I do want to thank everybody for today's call. Here's my information. Feel free to reach out, whether you're one of our subscribers or not. I'd love to hear from you. And as well, welcome any feedback from anyone on today's call. Thanks again.